Eurosif presents the results of the 2008 European Sustainable and Responsible Investment Market Survey. Published every 2 years, the study covers 13 European countries in depth, with the data collected by the National Social Investment Fora from across the EU. I am Matt Christensen, the Executive Director of Eurosif, and in this short video presentation, we're going to share with you some of the key findings from the market survey. The EU SRI market study is one of the most sought-after publications that Eurosif produces, used as a reference by leading EU political figures, institutional investors, and many other stakeholders. For those of you who wish to review the data in further detail, please go to the Eurosif website where you'll find a link to download the study. I would like to personally thank our sponsors who made it possible for Eurosif to conduct this research. Without them, Eurosif would not have been able to gather the information from over 250 respondents and bring it to you today. The sponsors were Groupama Asset Management, Highland Goods Steward Management, EDM, a division of the Credit Agricole Asset Management Group, and Natixis Asset Management. As you can see in this chart, the overall EU SRI market has significantly grown since 2003 and now represents a total of 2.7 trillion euros. In the past 2 years alone, the real market growth was 86%. In terms of market share, Eurosif estimates that the EU SRI market now makes up approximately 18% of the overall European assets under management. In the chart, Eurosif divides the market into two segments, core and broad SRI. The core SRI, in brown, encompasses more than 2 negative exclusions as well as positive screens such as best-in-class and thematic investing. The broad SRI, in blue, is composed of 3 strategies: simple exclusions, engagement, and integration. Both segments are growing and innovating. Looking specifically at the broad SRI, the integration approach has become really popular over the past 2 years with institutional investors. They are increasingly looking to integrate environmental, social, and governance criteria with their traditional financial research. This is partly because of the success of initiatives like the PRI, but equally because of an evolving definition around fiduciary duty roles and responsibilities. Groupama's Ronald Lescure speaks more about this mainstreaming trend among institutional investors.
It's very important that the markets, the managers, the fund managers and the buy-side analysts take on board extra financial analysis, because more and more the market are going to look at companies with those eyes. We don't want the SRI analysts to be in one side of the story and the real serious financial stuff to be on the other. We want them to be together and look at companies together. So all our financial analysis is now released and used by our fund managers in the management of our portfolios, has 2 sides, one financial and one extra financial, that helps them to integrate those questions into their day-to-day fund management in making sure that all the portfolios we have can be monitored and ranked and reported on using extra financial glasses.
Core SRI has also experienced significant growth over the past 2 years. In this chart, you can see that core SRI has experienced compound annual growth rates of as high as 90%. The markets of greatest growth were in Germany, France, and Switzerland. This reflects a continued interest in best-in-class investing, as well as an explosion of interest in the new thematic funds. Nathalie Monnayeur of EDM discusses their institution's use of thematic funds as a novel form of best-in-class investing.
So, sustainable development thematic fund management that use extra financial analysis, like our Aqua Fund, for example, is obviously a very different story. But one could easily argue that it's the best-in-class approach of another kind, bringing a kind of diversification because of its very different sector composition and also very different size bias, since thematic funds usually have a more small cap bias than large cap funds.
One of the interesting developments that the study shows is the continuing evolution and innovation in European SRI. Investors are now looking at the elements of both core and broad SRI and ways to use both of those strategies in approaching fund management. Samy Gautrain, head of SRI at Natixis Asset Management, explains more about this phenomenon.
Today, the so-called SRI best-in-class approach is roughly a mix of positive screening and a selection of companies within each sector that score best. We think that such security selection is an old-fashioned one, and we have decided to go beyond and achieve an integrated SRI best-in-class management. To achieve that, Natixis IM has developed a proprietary model called SRI Alpha. Thanks to such a process, we establish a tangible link between the extra-financial world and market valuations.
So far, all the strategies we've been discussing were really oriented around publicly listed equities. Equities has been one of the mainstays of SRI, but in fact, over the past 2 years, SRI has really started to move to actually look at alternative forms of asset allocations beyond publicly listed equities. In this chart, you can see that equities still represent a big chunk of SRI asset allocations at roughly 50%, but that's gone down from previous years. Fixed income is now 39%, for example. Perhaps most interestingly, the alternative section now represents 11% of SRI asset allocations and are the fastest growing area for investors. This includes property, private equity, and hedge funds, among other areas, all using sustainable and financial criteria. Highland Good Steward Management is an example of this new trend of investors within the sustainable alternatives asset class.
We're a socially screened hedge fund of funds. The study allows people who have ideas like ourselves, people who are willing to develop products like ourselves, are able to look at what the market needs and design products for specific application in that market. So thank you, Matt, thank you, Eurosif, and also thank everybody who participated in this study.
Especially in this current financial environment, Eurosif found that respondents believe that SRI is poised to be in even greater demand due to its focus on the long-term and proper integration of ESG risks. For example, this chart points to 2 of the key drivers for future demand in the coming years. The first will be increased demand from institutional investors, for which this area becomes even more a matter of proper risk management and potential for alpha. The second is shifting legislation, and especially at this current time, where calls for better disclosure and transparency are growing. In fact, because of and in spite of the current financial crisis, Eurosif believes that the SRI sector will be even better positioned by the time the next market study is launched in 2010. In concluding, Eurosif wishes to thank the member affiliates for their ongoing support of Eurosif's mission to address sustainability issues through financial markets. Undoubtedly, the financial markets are indeed in the midst of an acute global crisis. At the same time, ESG criteria are likely to play a more significant role across the entire financial services sector across geographies. We invite you to stay abreast of all European SRI trends and information through our website, eurosif.org. Thank you very much.